Welcome to this tutorial. This is a revision class that will be taking you through some of the examinable area, like the adjusted present value, the sources of finance, bond valuation. So basically, I will just be discussing some of the things that you need to know for your exams. So let me start with the adjusted present value. So what is the adjusted present value? It is basically a method of appraising projects, but it is a little bit different from the traditional method. In the traditional method, the project cash flows are discounted using the weighted average cost of capital. But using the adjusted present value, the project cash flow is divided into two components: the base case NPV and the PV of other costs. So what is the base case NPV? The base case NPV is just simple. The cash flows of the projects are discounted using cost of equity ungeared. Instead of using the weighted average cost of capital, you use the cost of equity ungeared to discount the cash flows. Then the finance side, which is the PV of other costs. What are you doing there? So basically, let's just look at the basic things you need to solve a question. So how do you arrive at the cost of equity ungeared? There are two ways to do. So how do you arrive at the cost of equity ungeared? There are two ways of arriving at this, depending on the information you are being given by your examiner. So it's either you are degearing the beta of equity to arrive at the beta of assets, or you are degearing the cost of equity to arrive at the cost of equity ungeared. So now this is your beta of assets. How do you arrive at your beta of assets? From your risk-adjusted cost of capital, this is the formula to arrive at the cost of equity ungeared. So your CAPM formula, basically, you have KE is equal to RF plus beta into RM minus RF. So in this formula, basically, you are using beta of equity here. You are calculating your WACC. But under the adjusted present value, you will not be using the beta of equity. So if you are doing the adjusted present value, what will be here will be beta of assets. So that after you've done this calculation, you will arrive at KEU, cost of equity ungeared. Alternatively, because your examiner may give you a company data, a prosy company, and if the examiner give you the beta of equity of that prosy company, you need to convert that beta of equity towards beta of assets for these projects. So secondly, your examiner may give you the cost of equity. The examiner may decide to give you KEG, cost of equity of a shared company. So if you are given the cost of equity of a shared company, how do you arrive at the cost of equity there? So this is the formula for degearing the cost of equity, almost similar to the formula for the beta of equity. So if you have KEG, you degear it using this formula. The moment you degear it, you will have your KEU. So once you've gotten this, immediately you can use it to calculate your base case NPV. Finally, let's look at the PV of other costs. So what constitutes other costs? Here you are separating the equity finance and the debt finance under the traditional cost of traditional project evaluation. The cost of debt and the cost of equity is put together in a basket, and you use it to calculate your weighted average cost of capital. But here, the effect of the debt financing is separated. So the PV of other costs or the financing side effects, these are basically what you'll be seeing. Issue costs. Issue cost here is in brackets because it's an outflow. It's a cost. This is a benefit, tax shield on loan. You may have two types of loan, a commercial loan and a subsidized loan. Then the PV of the subsidy and tax on subsidy. So let me explain each of these variables one after the other. The issue cost here, in your exam, your examiner may give you a question that the company wants to raise debt finance, and the cost of raising the debt finance is 1%. So at times, the examiner tells you that this cost will be financed by equity. So if this cost will be financed by equity and the company needs to borrow, say, 500 million naira, there will be no need to gross up this 500 million naira. Okay? But if your examiner tells you that the company does not have sufficient funds to pay for the issue costs, the question may come in such a way that issue costs will be 1% of gross finance needed. Gross finance. So what is the examiner saying? That the issue cost is 1% of gross finance. So it means that if the company needs 500, right, this 500 that the company needs for the project is what? The net amount, excluding issue costs. Okay, but the gross finance is this 500 plus the issue costs, which is 1% in this case. So how do you know what the gross finance will be? Now I know that the net finance is what? 500. So how do I know what the gross finance will be or what the issue cost will be? So you can solve this in two ways. One is either you first of all get the issue cost separately, then add to this, or you decide to get the gross finance and take 1% of it. So what anyhow you want to solve it, this is just what you do. What you need is 500,000 and the gross finance is what you are looking for. So 1% will be 1 all over 99 times 500. So this will give you the issue costs. 1 over 99 times 500, that will give you the issue cost. But if you need to calculate just the gross finance, what you just need to do, you just say 500. So if I use this first method, 1 over 99 times 500, so whatever I get, let's assume that whatever I get, I'll now multiply it. Let's assume that what I got is X. So I will now say times 1%. That will give me the issue cost. Sorry. Whatever I get here will be your issue cost, rather. 1 over 99 times this 500. Whatever you get will be your issue cost. So if what you finally get is X, okay, so your gross finance will now be this X that you got plus this 500,000. That's one way. So the second way is to just get the gross finance. Since what I am looking for is 500, an issue cost will be 1%. So the gross finance will be 500 all over 0.99. That will give me the gross finance. Whatever figure I get, I take 1%. That will give me the issue cost. So if the issue cost is 2%, for instance, this will be all over 0.98. So if issue cost is 3%, this will change to what? 97. It is 5%, the denominator will be what? 95. Okay, so that's about the issue cost. So there are times the examiner will tell you that the issue cost is tax allowable. If it is tax allowable, it means that if your issue cost, for instance, is 50 or 500 and tax rate is 20%, so that means you are going to get a benefit from this of 1 minus 20%, which is 0. Sorry, let me take this off. So your tax rate is 20%, so your benefits will just be 500 multiplied by 500 times 0.2. So that will give you the tax benefits. So if your tax rate is 40%, 0.4 times the issue cost, that will give you the tax benefits. That's if it is tax allowable. So using the adjusted present value, there are times when you will be given a question that's assuming the company needs to borrow 1 million, and you are told that 50% or 40% of this amount will be raised via a subsidized loan, while the balance of 60% will be raised via a commercial loan. It means that you will have two different interest rates here. So 60% will be 600,000 commercial loan. 400,000 will be what? Subsidized loan. So the commercial loan is basically a loan that the company can secure at its own incremental rate of borrowing. So if the normal rate of borrowing of the company is 10%, right, and the company borrows 600,000, it means that the company will be paying interest of 60,000 on that. So 60,000, and if the interest is always tax deductible. So the tax benefit is what you are interested in, not the interest itself. So if tax rate is 30%, this will now be times 30%. That will be the tax benefit on the interest. Okay. So another thing you need to know is that this project will be for a number of years. So whatever you get here, 30% times this, whatever the figure is, it will be for quite a number of years, year 1, year 2, to maybe year 4 or year 5, depending on the number of years. So for the subsidized loan, it is a loan that is basically given by the government for companies investing in preferred sector. So the government can decide to give a loan lower than the incremental rates, say at 6%. So there's a subsidy element in this loan because basically the company can borrow at 10%, but the company is now getting the loan at 6%. So there's a subsidized subsidy element, which is 4%. So the interest on the subsidized loan will be lower than the interest on the commercial loan, which will now be 400 multiplied by 6%. That will be the interest. Then you now factor in the tax benefits times what? 30%. So that gives you the interest elements, that the tax shield on the interest on the subsidized loan. Then what is the subsidy? The subsidy is this 4%. So the subsidy there is the 4% here. And now, how do you do the calculation of the subsidy? So we are assuming that the loan that the government gave is 400. So the subsidy will be 4% on 400. So whatever you get comes in here as the subsidy. So since the loan has been subsidized, it means that the company has add a savings, which is this subsidy. So the company is going to pay tax on that savings. So if tax rate is 30%, that means the company will pay tax of 30% on this subsidy. So this tax will also be what? An outflow. So this is just the summary of the PV of other costs. So when is it appropriate to use the adjusted present value method to appraise a project? One, when there is a significant impact of debt financing. That's the company is taking a significant debt to finance the projects. Two, when there's a subsidized loan on the project. And three, the project under consideration has a different business risk. So these are the basic three situations that may give rise to the use of what? The adjusted present value method. So this is just a question. So I may just use this question to still um, emphasize what I've explained earlier on. VANTI requires 850 for a capital project. So this is what the company needs. So this is the net finance. So this is the net finance. For a capital project, 70% of the outlay will be financed from the issue of bond. So the interest rate there for the bond is 10%. So this 10% is the normal rate that the company can borrow. Issue cost on the bond is 5%. So there's an issue cost for this bond. 5% off, look at the word here, off the gross finance. So that means we are saying the issue cost will be what? 5/99 times whatever the company raised through bond. Okay. The balance will be financed by a subsidized loan and equity share in the same proportion. Okay. So 70% of the initial outlay will be financed by what? Bond, while the balance will be financed by a subsidized loan and equity. The interest on the subsidized loan is 6%. So if you can see here, the company can borrow at what? 10, but the company is being given a loan at what? 6%. So there's subsidy element of 4%. But okay. So let me continue reading. Issue costs for the share will be 2% of the amount raised, and this will be financed by retained earnings. So if this is the case, that means there's cash to finance the issue cost on the shares, but there is no issue cost for the subsidized loan. The company only has sufficient funds to pay for the issue costs of the shares. Tax rate is 30% payable in arrears. Okay. What is the requirement? Calculate the PV of other costs on the basis that the issue cost on the bond will be tax deductible and the project will last for 4 years. Secondly, recalculate the PV of other costs, assuming that the company borrowed an amortized loan instead of the bond. And the gross amount, the issue cost, that's the management fee, and the interest rate is the same. And that the issue cost is also tax deductible. It can be assumed that issue costs will be paid from amount borrowed. So there are two different scenarios here. The scenario one, the difference is that scenario one, the company is issuing bonds to finance the projects together with the share and subsidized loan. Scenario two, the company is issuing what? An amortized loan together with the share and also the subsidized loan. So for the bond, if interest rate is 10% and the company borrows 500,000, annual interest will be 10% times what? 500,000. Okay. But for the amortized loan, the interest is basically on opening balance. So what is an amortized loan? Just to refresh your memory, an amortized loan is a loan that you borrow that every year you make payments of principal and interest, equal installments, to ensure that at the end of the loan tenure, the loan balance becomes zero. So if I'm making payments, repayment of principal every year, if I borrow 500,000, right? So let's assume that it is 5 years and interest on that 500,000 for the 5 years, let's assume is 100,000. So 600,000. So I'm expected to be paying an equal amount every year so that at the end of the fifth year, this amount becomes zero. So it means that every year the principal will be reducing. So let's assume that payment of principal out of this is 100,000. So the second year, principal will have reduced to 400,000. So interest for the second year will be based on what? 400,000. If the principal reduced to 300 in year 3, interest will be based on this amount. So that is the difference. The interest is not a flat rate on amount borrowed. Okay. So let's look at the solution. It's just a simple question. The amount needed is 850, right? 70% will be financed via bond. So 850 times 70% gives this amount. And issue cost will be 5%. Okay, so in this scenario now, what was calculated here is not the issue cost, it's the gross amount needed. So gross amount needed is this divided by 0.95 because issue cost is 5%. So the total gross amount needed with respect to bond is what? 626,315. So out of this amount, the company will now pay issue cost of 5%. So the balance will now be the net amount. So this amount minus this amount will be what? The issue cost, which is 5%. Equity will be 15, while subsidized loan will be 15. And this is the amount for equity. We're told that the issue cost of equity will be paid out of cash. So there's no need to gross it up. Since the company has sufficient cash to pay this, so there's no need to gross it up. Subsidized loan, there's no issue cost for subsidized loan. All right. So how do you do the calculation here? So the moment you have done this already, you are almost, you've gotten what you need to solve the base case and MPV. Sorry, in this question, there's no base case MPV. What you need to solve what? The finance side. So let's look at the discount factor. Year 1 to year 4, the project is for 4 years, but anytime tax is to be paid in arrears, that means there will be what? A fifth year. Anytime tax is to be paid in arrears. If the project is for 4 years, then there will be a fifth year. If the project is for 5 years, then there will be a sixth year. Okay. So annuity for 4 years is this. Since tax is going to be paid in arrears, you still need to calculate annuity for year 2 to year 5. This is year 1 to year 4. So you still need to calculate year 2 to year 5. So this annuity year 2 to year 5. So how do you do the calculation for that? First of all, calculate year 1 to year 5. then deduct year 1 to arrive at the year 2 to year 5 figure. So the interest on the subsidized loan is 6% lower than the commercial loan. Commercial loan was supposed to be 10%. So interest on subsidized loan is 6% times this. So that gives this amount. So the bond, interest of bond is 10% times this amount. So that will give 62632. So this is just the solution. So basically, your issue cost in year 1 is this. Tax benefit, the tax is 30%. So 30% of this, and tax is paid, this tax is paid 1 year in arrears. So this is year 0. Issue cost is in year 0. Your tax is paid 1 year in arrears, which will be in year 1. So the tax benefit on this issue cost will be enjoyed in year 1. Issue cost on equity is year 0. So it's not discounted. You are using 1 for the year 0. So this is the issue cost on equity. So for equity, there's no tax benefits. So these are the interests. Subsidized loan, 30% of the amount given by the government. Commercial loan, 30% also. So this gives you 22.9, while this gives you 18,790. So if you add it to the total interest to be paid for the period of 4 years, year 1 to year 4, is this amount. Discount factor, annuity year 1 to year 4, which was calculated, is this amount. So now there will be a subsidy element, 10% minus 6, which will be 4% times the amount borrowed by the government. So this is the amount the government borrowed. So this is the subsidy element. So this is year 1 to year 4. And this is the final figure for the 4 years. Sorry, the subsidy is year 1 to year 4, while tax on subsidized loan, since tax is paid 1 year in arrear, anything that has to do with the tax will be year 2 to year 5. So this is year 2 to year 5. This is year 2 to year 5, while the subsidy itself is year 1 to year 4. So your PV becomes this amount. So the difference now between this and scenario 2 is this. So this is the amortization schedule. So anytime there's going to be an amortized loan, you may need to calculate an amortization schedule. So this amortization schedule, let's see, the total amount that is required, which we calculated earlier on, is 626,320, including the issue cost. So this is the gross amount. So this annuity factor was calculated earlier on, year 1 to year 4. So if you divide it by that annuity factor of year 1 to year 4, which is 3.1699, the annual payments of interest and principal will be 197,582. 197,582. So, but what you actually need here is the interest element. That's what you need here. So let's look at that. How do you calculate it? So interest is 10%. So this is the initial amount in year one. So 10% of that amount is 62. Total loan repayments, 197. So your closing balance will be this. Opening balance for year two will be your closing balance for year one. So interest of 10% on this amount also gives you this. So at the end of the fourth year, you are expected to be having a zero balance year. Okay, but because of approximation error, there's 8 here, but you ignore this 8. So basically, what do you need from this table? The interest. That's what you need from the table. All right, so the moment you get this interest, you just discount it. So these are the interest elements, 6249, 3417. So you discount these interest elements the moment you get it. Okay, so but these interest elements here. So tax shield is at 30% of these interest elements. So these are the tax benefits. Okay, so you discount the tax benefits. This is year two because tax is paid in arrears. This is year two. This is year three. This is year four. And this is year five. That's the timing for tax, right? But you get the benefits year one to year four. The tax timing will be year two to year five. So this total figure is what you will take into your cash flow table. So every other thing remains the same, the way we solve it in the very first question when the bond was used. Every other thing here is the same. So the only difference is what? Tax shield and what? The amortized loan. So that's the only difference. Every other thing remains the same. Okay? That's just the way to solve the finance side effect on the amortized loan. Let's look at the base case NPV itself and see what it looks like. Okay, let me just use this question as a case study for that. Okay. Okay, so I'll just be reading the question and be making some comments, but I will not solve the question in totality. Toju PLC is a listed company in the Nigerian Stock Exchange. Currently, the company is into event planning and logistics. The company is considering an investment in the agricultural sector. Sabico is one of the companies operating in the agricultural sector in Nigeria. So I want you to take note of this. Sabico is a proxy company. So you need the data of this company for this investment appraisal. The debt to equity ratio of the company is 1.1 is to 3.5 and has a quoted beta of 0.925. So basically, I told you that you will need the proxy company either to calculate the beta of assets or the cost of equity on share. It depends on the information given. In this question, we're not giving the cost of equity of Sabico. Instead, we were giving quoted beta. So is this quoted beta of assets or beta of equity? I'm going to look at the capital structure. Is there debt in the capital structure? Debt to equity ratio is what? This. So that means there's debt in the capital structure. The company is not all equity finance. So it does mean that this beta, quoted beta that is given is what? Beta of what? Equity. And I need to convert it to beta of assets using this formula, beta of asset equal what? Beta of equity, and so on and so forth. Okay. The investments will require initial outlay of 1.5 billion for the acquisition of plants and machinery. The asset will be depreciated for tax purposes on a straight line basis over the 5-year life of the project. So the project is to be carried out for 5 years. The asset will have a negligible value at the end of the 5th year. So value there will be 0. This other information here relates to sales and production. So these are the units to be produced, projected unit to be produced, projected selling price per unit. So sales for year 1 will be this multiplied by this, and for the other years, the same principle applies. Variable cost will be this in year 1, year 2, variable cost per unit. So since these are the units produced also, variable cost per unit for year 1 will be tied towards this unit produced. 715 in subsequent year. Okay. So now I need to, anytime you are giving a price or a cost, you want to be sure that this cost is what you should be using. Right? So what do I mean by that? I want to know if this is real or nominal. So if it is real and I need a nominal value, I will need to convert this to nominal, but depends on what I need, right? So let's look at this. But sometimes the examiner will be silent. You won't see whether it is real or what's nominal. 715 in subsequent year. Head office apportioned overhead will be 2,000 to 2,005 per annum. And incremental overhead will be 20 million per annum. This is 2.5 per annum. The project will require working capital of 10% of anticipated sale in each of the periods. So most of the time, when you are solving question on the adjusted present value, you want to add this working capital in year 0 to the initial outlay. So in this question, the company needs 850. So you want to add that working capital, whatever it is, let's assume 200. So if you add this to this, you have 1,050. All right. So if you look at this question, the examiner is silent here about these prices, whether they are nominal or what, real. So definitely, I'm not going to bother myself with that. I'm going to assume this is what I'm going to use in year 1, year 2, year 3, since there's no inflation rate or whatever that I need to use to adjust these rates. Okay. Financing the projects. 50% of the costs of the machine will be financed by a 5-year loan from a development bank at a rate of 6% per annum. So which kind of loan is this? Is this a subsidized loan or a normal commercial loan? I can't say that for now. Let's continue. The company normal rate of borrowing is 8%. So since the company normal rate of borrowing is 8% and the company is getting a loan at 6%, that means this 50% loan is what? A subsidized loan. The balance will be financed by a 5-year redeemable bond. Issue cost on the bond will be 1% of the gross finance raised. Issue cost is allowable for tax purposes. Okay. The current asset beta of Toju PLC is 1.5. Now, you know that this current asset beta of Toju PLC, as far as this project is concerned, it reflects Toju PLC current operation. So this asset beta is not relevant as far as this project is concerned. Okay. So risk-free rate 5, risk premium is 7%. So what you need this for is to calculate what? The KEU. So if you digest the beta, you are going to get what? Beta of assets, which you use to calculate this. That's just all about the question. Let's go to the solution. So anytime you have a question that is saying that working capital will be 10% of sale or 5% of anticipated sale or whatever, that means before you calculate your working capital, you need to know what the anticipated sales figure will be. So in this question, these are the workings. So we're told that working capital will be 10% of anticipated sale in year one. So this is the sales for year one. 10% of this will be 66. Okay, so you need to first of all get that before you can proceed with the question. If you look at the total amount required, this is working capital. This is the amount needed for the plant and the machinery. So the total amount required in time zero is 1566. But the government has promised to finance 50% of the amount required, which is 750. So the balance will be financed by what? A commercial loan. So 750 minus the total amount. So the balance is now what? 816. And this commercial loan has an issue cost of what? 1%. So the gross amount to be raised via commercial loan will be 816 all over 0.99. So that gives approximately 824. So the issue cost is tax deductible. So the same way I treated the other question initially, so that's the same way this is also going to be treated. So everything here remains the same. Tax benefits, issue cost always here 0. Tax benefits on the issue costs, here 2 to 6. The project is for 5 years. So the tax is in arrears. So it will be a 2 to 6 for both taxes. And this will be the present value of that particular benefits. Okay. So this is just basically a summary of what you expect in your exam with regards to the adjusted present value. So this is just like the summary of what you will be expecting in the exam. So the sales revenue is just the same way you calculate your sales revenue. So working capital, we're giving working capital to be 10% of what is needed. So these are the various sales for the various year. This is the sales, so 10% gives this amount. So the timing, the first amount to be needed was in year 0. So the difference between this and this will be for year 1. So the difference between this and this will be for year. So just like that. So if you look at year 5 and year 4, we have the same figure. There was no changes there. So this gives us 0. And at the end of the project, everything here will be recovered. So at the end of the project, you sum up everything here and this will be recovered. Okay. That's just that for the working capital. So tax is on straight line basis, definitely. So that's easy. Just divide the amounts needed for the machinery by 5. That will give you the annual depreciation. So tax benefit will be this annual capital allowance times tax rate of 0.3, which is 90 million. So the discount rate for the project is calculated here this way. Since we're giving information of Sabico and what we're giving, we weren't giving the data of assets. What we actually need to calculate the CAPM is the data of assets. So we're giving better of equity. So this is converted to what? Better of assets using this formula. Debt is assumed to be risk-free. That means this part of the formula becomes what? 0. So this is the better of assets. Plug it into the CAPM formula. Because of equity on GL become these amounts. Okay, so these just basically a refresher for your for the adjusted present value, just to refresh your memory. All right. So we'll be looking at bond valuation. What do you need? Just also a refresher on the bond valuation. So let's see what you may be needing in the bond valuation. So basically, bond is like a debt instrument. It's a debt instrument, basically, that a company uses to finance its operation. Most times it is used for long-term projects. When a company has an outflow, that's a project that requires huge sum of financing. So the company may decide to issue bonds to finance the project. So there are basically two types of bond that you will come across in your exam: the straight bond and the convertible bond. So this basically, the straight bond, there's no option for conversion. The company at the end of the loan tenure, if it is a 5-year redeemable bond, for instance, at 5% or 10%, let's say 15% bond, and the duration is 5 years. So at the end of 5 years, the company will repay the bondholders the amounts borrowed. So the bondholders is like they are borrowing the company money. So for the convertible bond, the company or the bondholders have the option to convert at maturity. So the bondholders will decide to convert. If it is more favorable to them, they will convert it to shares. But if it is not, they will allow the option to lapse. So, but you can check my video on bond valuation. I'll just only refresh your memory in this lecture. So these are the advantages. There are some advantages of the bond valuation to the bondholders. I think that is in my video on bond valuation, introduction to bond valuation. So the value of a bond simply is the interest and the redemption value. That's the present value of these two, is the value of a bond. So if you have a bond or you borrow a company money rather, if the company decides to be giving you interest of 600 annually for 4 years, so 600 times 4, that's 2004. So you will have received 2004 at the end of the 4th year. And at the end of the 4th year, let's assume that the amount you borrow the company is 6,000, and the company is paying back 6,000 at the end of the 4th year. So this becomes what? 8,400. So it means that the value of your investment is what? 8,400. And the investment we are talking about here is what? The bond. But now, because of the time value of money, we are not going to just say it's 8,400. You look for the present value of this interest and the present value of this principal repayment. So that is just the value of a bond. That's how to calculate the value of a bond. So if we move further, this is still calculation of the value of a bond, but a convertible bond. So if a bond is a convertible bond, there are two things that will happen at the end of the loan tenure. So in this question, we have conversion value of 140 if the bond is converted. So if the bond is redeemed, what will be the value if the bond is redeemed? So you compare these two values, the conversion value and the redemption value. Whichever is higher, That's what you are going to use here. So this is sources of finance. I also did a video on that, but I'll just do a revision here. It has to do with how companies fund their projects, how they fund their projects, both in the short or long term. Basically, there are short-term sources of finance, like your bank overdrafts is a short-term source of finance, short-term loan, trade credits. You have bill discounting, factoring, and all of that. Those are short-term sources of finance. For SMEs, what's also their sources of finance? It's just basically most of those short-term sources of finance. For the SME, they can't raise bond, they can't issue share to the public and all of that. So that's for SMEs. Then if we move further, we have, okay, let's move further. Long-term sources of finance, that's where you have equity, bond, long-term loan, leasing, preference share. So these are long-term sources of finance. Okay. So this is just to refresh your memory, method of raising source of finance for using the equity finance for small companies, SMEs, maybe from friends and relatives. There may be some private equity company also invest in small businesses, but for public companies, you can now use the public offering rights issue. So these are basically the ones that are being used for what? Large companies. Okay, so venture capitalists, those are part of the private equity company and business angels. So these are companies that basically invest in startup business. So for the venture capitalists, they are professionals who invest money into startups on behalf of a company, a risk company. But for the business angels, they invest their own money into what? Startup. Most of the time, they tend to provide mentorship to these smaller companies. This here, they supply other people's funds, while these finance using their own funds, their own money. Okay. So public offering. What is public offering? That's to do with public company issuing their shares to the public. So public offering most of the time is done through an investment bank. So the initial public offering is known as the IPO, when a company is issuing its share to the public for the first time, while the APO is when a company is issuing additional shares to the public. So additional shares to the public becomes what? An APO. Method of public listing. So a company can go public through what? An initial public offering, which is most of the one that is common. An introduction, the company is not raising money. The company is just introducing its share to the exchange. The company's shares are already widely subscribed. They will have the placements. So the placement is a process of selling shares of a company to specific private investors or through a private transaction. Selling shares to the public through a private transaction to a selected people. Basically, maybe sales to institutional investors like fund managers. That's where you see the placing. Okay. So what are the advantages of public listing for a company to be listed in the public or the stock exchange rather? It improves liquidity, public awareness. It's easy. People get to know the company. through maybe TV, magazines, and all of that. The company's image is seen to be better. The company will have a wider pool of finance. The company will easily attract institutional investors, and also purchase consideration. If the company is to be valued, since the company is a public company, it will be easy to value the company because its shares will be trading on the exchange. So that indices will be available. Then transferability is easy to transfer your shares in a public company than a private company. So the disadvantage basically is the cost. Then regulation increases with that decision to go public, and also depending on the number of shares that is being sold. So it may lead to dilution of what control. So right issue, I have a video on this also. You can check that for the right issue. So finally, I will want to discuss on Islamic financing products. So what are those things that a company should look at before deciding on the sources of finance? So for equity finance, you are looking at the cost of issuing. Shareholders may also be concerned about dilution of shares. And also, if the company is highly geared, the company may decide to use what issue of shares, either a right issue or issue to the public if the company is highly geared. So these are some of the things a company will be looking at while issuing shares. Okay. So for debt financing, the company will be looking at collateral. Does the company have the required collateral for the debt financing? It's also be looking at the level of gearing. You'll be looking at the cost of raising that funds to ensure that the company is not doing the business at a loss. This is least so Islamic finance basically has to do with a company financing its operations through the Islamic bank. So these are the things you'll be looking at for the debt financing: interest, gearing, covenants in the debt, project duration to ensure that it matches with the loan duration, and also the nature of the projects. So the Islamic finance has basically two products: equity-based and income-based. So for the Musharaka, so let me start with the equity-based. There are two products under the equity-based: Mudaraba and Musharaka. So these are Islamic terms. It may be difficult for you to track. But anytime you hear Musharaka, what I used to track this is sha. I'll just say share. Musha, share. So I'll just say this is share. So anytime you are sharing something, it's like a partnership. So anytime you are sharing, it's partnership. So the moment I just share, partnership, sharing, okay, profit and loss or whatever. So it's the same concept with what the partnership, the musharaka, same concept with the partnership, where two or more people come together to provide the finance for a business. And all of these people, so when you are looking at Islamic finance, there are basically two things you are looking at. One, how the company will be run. Two, how profit and losses will be shared. So for the musharaka, all parties have rights in the day-to-day affair of the business. Okay, so all the parties can participate in the day-to-day running of the business. Then profits can be shared according to what an agreed ratio, or the according to an agreed ratio, or the proportion of contribution by each party. So that's the way profit is to be shared. But losses will be shared strictly according to what contribution made by what each party. So I think that again, profit is going to be shared according to what an agreed ratio or the contribution made by each party, the proportion of their contribution, while losses will be shared strictly in accordance with what the proportion of what the contribution of each party. So that's the musharaka. So if we move back down to mudaraba, mudaraba is like a limited liability company. Somebody provides the finance, and the provider of the finance does not engage in the day-to-day running of the business. It is the duty of the mudarib to do what? To manage the business. Then how is profits or losses going to be shared in this kind of arrangements? The losses will be shared solely by what? The financier. It's just like a limited liability company. Workers in the company, even there is loss, they are going to be paid. But it is the shareholders that takes the burden if there's going to be any loss. Okay, but profits are to be shared in accordance to what a pre-agreed ratio. That is the mudaraba. Then the muraba'a, these first two that I just mentioned, they are what equity financing, while this is more like a trade credits or financing operation. So muraba'a is a situation whereby a company finance its operation using the Islamic bank. What the Islamic bank does is to help the company buy that commodity. So if the bank buys the commodity, the bank sells to the company at what? A markup. So there'll be a percentage there. Instead of the bank giving the company the money to go and make that purchase, the bank will be looking at it that the company may not utilize that fund properly. So let's buy the products and give the company. So we know that that fund is utilized for the purpose for which it has been borrowed. Okay. So Ijara, that's the next one. Ijara is lease, similar to short-term leases, where the bank leases the equipment and gives to the company. So the asset remains the ownership of the bank. So the bank is the one that still owns the assets. Okay. So, but basically, the bank just leases the assets to the company for a specific period. So the lease period and the payments and the terms of will be in the terms of the contract. What will be paid at the period will be in the terms of the contract, just like a normal lease arrangements. So finally, we have the sukuk, which is similar to what bond. But under these arrangements, the Islamic bank does not collect interest, but instead it is profit sharing. The bondholders share in the profits of the company, because in Islamic finance, interest is seen as what? Like as a taboo. So there's nothing like interest on borrowing. So that is the Islamic finance. So this is just basically a revision on the sources of finance to give you a refresher for your examination. So wish you good luck as you write your exams.